Everybody, hope you're well. Welcome to December. I got the holiday decorations up on both sides here and all around me. I can't believe we're already flying through December. We'll go through a little bit of what happened in November here and take a look forward as we move through December on what things look like and some historical perspective. So November on the Canadian markets were positive, much more positive than the U.S. markets, which barely eked up as a gain, but didn't actually have an all-time high. So zero all-time highs in November. You can see June through October, the majority of them up 36 all-time highs. Nothing in November. We'll see what happens in December here as we move towards the end of the year. One thing of interest and another case for diversification, you can see that first row there looking at healthcare and the columns being last month's returns versus the year-to-date returns. And you can see the sectors there if you go all the way to the bottom. Technology, which has been the big driver and something we've talked about really driving the markets overall in the S&P 500 since those large cap tech names are such a big weight of the S&P 500. It's actually down almost 5% last month, still up 23% for the year. But you can see that's what really dragged that S&P 500 as the majority of sectors were positive. So another case for diversification, not just geographically, as we've seen the Canadian market outperform this year, but also sector by sector, looking at different asset classes when you diversify your portfolio. And another point to being watching those weights on those high tech companies, whether you're invested in them specifically or in that S&P 500, which, as we've said, is overweighted to those companies. Here, looking forward to December, not always the highest average return, which is the blue bar, but that yellow diamond there showing the percentage of times that the month is higher. You can see it's the highest there, 73.3% of the time December is higher. Didn't happen last year, definitely didn't happen in 2018, but going back historically to 1950, December is the best percentage of moving higher compared to most months. You can see January is also fairly strong there at 60% of the time. We'll see what happens as we move through the month, but keep this in mind that the majority of those returns happen in the second half of December. That so-called Santa Claus rally usually doesn't start until mid-December. So we might get some choppiness as we move through the beginning of December here. So keep that in mind that historically the gains happening in the second half. Another good piece of historical data here, December's rarely down 2 years in a row. As mentioned last year, we were negative. So 2 years in a row doesn't generally happen. Happened in 2014, 2015, but doesn't usually happen. So we'll see again what happens in 2025 here. You can see that big negative I was talking about in 2018 in December. Definitely hoping we don't get a repeat of that. But as mentioned, going back, not historically negative 2 Decembers in a row. And another good piece to look at here, when the markets are down over 15% at one point year to date, which we saw, of course, in that March-April correction of the markets, we were down 15.3%. The year-to-date number is usually strong, as we're seeing at the moment, but also next year's returns are usually strong. So going back, this only happened since 1950 here. If the market goes down over 15% and rallies back the next year, generally strong. You can see it's only happened 3 other times, but that average of 19% positive in the following year. So a good sign looking into 2026. A couple of interesting charts here as we talk a lot about inflation, a lot about wages, especially coming out of COVID. You can see we had, after that initial COVID spike of growth, a lot of negative real wage growth. So inflation was very high. Wages weren't going up that much. We had 25 consecutive months where wages were not going up as high as inflation. But since then, if you flip back to about 2.5 years ago, 29 consecutive positive months now where the average earnings, this is in the U.S., the average earnings has been higher than inflation. And of course, we know inflation has stayed a little sticky, higher than we want it to be. Of course, nowhere near as high as it was a few years back, but still higher than it should be, but wages are outpacing that at the moment on average. So that's actually a good sign for the economy as we move forward. One last one, just to keep things in perspective here, there's probably a lot of holes that can be poked in this data as it goes back to 1820 here. But as you can see, the extreme poverty, and this is all adjusted for inflation, so extreme poverty in 2018, haven't had an update since then, but suggesting anybody living on $1.90 in today's dollars or less is in extreme poverty. That number's gone from 76% of the world population, again, inflation adjusted, down to just 9%. Now, of course, it can definitely have a case being made for extreme poverty being anybody less than $5 or even $10 a day being able to get by, and you can see those numbers dropping as well. But really the case here and the thing to consider here is that 85% of the population, the world population, is living on less than $30 per day. If you take that into perspective in your own life, likely something to be grateful for, and something to keep in mind as you move through the holiday season and things like Giving Tuesday and just the life we live as we move through the holiday season, enjoy time with family and friends. So I thought that was interesting to look at. Again, I'm sure there's lots of ways to view this, but things have gotten better on for a lot of the population as far as extreme poverty goes. Still a long way to go, of course. Anyway, I'll be back with you before the holidays with some more charts and an update on the markets. Of course, as always, any questions, reach out. Happy to chat. Take care, everybody.